Good evening, ladies and gentlemen. Today is the 2nd of July, and we opened the day quite flat, and more or less everything seemed to be flat to negative bias, same as always. We had quite a dip, we had a 60-point dip, but the options pricing was such that it really wasn't expecting too much downside. Today was one of those days where I had a very strong view that it's very, very unlikely that we see further downside, and in fact, would see short covering move, at least pulling us to 15,700. So, view was on point. But as always, I don't take extremely risky trades. So, many people will come and ask me, okay, this was your analysis. This was why didn't you take a trade that would benefit maximum, like something like a long call or shorten in the money put and take that kind of directional risk. It's just because the risk management for me will always come first over my view. I don't put too much emphasis on my view. I have a view and I execute it with a room for error. So I don't mind not gaining from having a very good view, because I know many times I've had views that would have gone horribly wrong had I not done the proper risk management in case that view goes wrong. So today was one of those days. I took an exit at about 1 o'clock or so, as it benefited immensely throughout the entire day. For Friday, 1% is a very good return. And after that, I initiated a calendar spread, as I was not expecting too much further reward potential given where the position was at that point of time. So a good Friday, and all said and done, I think as long as once again you were on the credit side, it should have worked out. Um, Today, one of those days where once again you had to buy into the fact that when market is pricing in such low volatility, the actual volatility should probably follow. And for 2 days in a row, that has been the case. And with the straddle though of 15,700, if it does close below 160 on Friday, I might not be doing intraday strangles on Monday or Tuesday. It depends on how things are looking, or I might do it with a very, very less tolerance for risk. So that we'll have to wait and see. Meanwhile, I'll have my calendar spread open, which is a new position that I've just entered. I've gone over it towards the end, and any changes I do make to that, in case I don't post them on YouTube because I'm not trading the entire day that day, I'll post about them on Twitter. Thank you so much for watching. I hope you had a good trading day. Have a great weekend, and I'll catch you next week. Take care.
Want to meet like minded traders and discuss option strategies, adjustments, and more? Just type in Discuss Nifty in your Telegram search box and join the friendly trader community.
Good morning, ladies and gentlemen. We just have the pre-market settling. We're opening quite flat, just about 15,700, slightly in the green. And generally, being a Friday, if there isn't too much of a move, you can see a pretty good fall off in OTM premiums. Currently, the 15,700 straddle is trading for about just under 190. So, given that today is Friday and we're already in a low premium environment, my plan is to take a delta neutral strangle of 15,500 and 15,900, which is basically right just around here, 15,500, which has seen buying multiple times, and 15,900, which has seen selling multiple. This is the range, 400 points. If I can get 50 bucks for it in this current environment, that would be quite good. Let me see. I'll have to wait and see what prices are available. I'll wait for the first 5 to 10 minutes to let whatever jitters are there play out, and then we'll take entry. I'll keep you posted. Time is 9:14. Okay, so right into the open, heavy selling in IT, and quite a lot of buying in Reliance. But we're making a slight dip from the open, leading to an increase in these puts. I initially entered at the 15,500, 15,900 strangle, but for now, in order to balance the fact that there's really not much premium on the 15,900 call, had to roll down to the 15,850 call. Now, basically, this position is delta neutral at 15,675. In case we start breaking below 15,650, and by then there is still no buying, then I will even more aggressively bring down the calls to 15,800. So that's the plan for now. And yeah, we'll keep you posted. Currently, the 15,700 straddle is trading for about 182 183. So pricing in about 200 points up and down for the entire week. So given that, this is a fair enough position to be in. Right now, into the down move, the puts are gaining, but the calls are really not giving up much value. So that being the case, do not want to be too quick to roll down the calls also. Keep you posted. Time is 9:23. Okay, the puts still have a lot of value. So what I've done is roll down about 25% of the calls to 15,800 quite aggressively, because in case there is a continued down move, I need that kind of credit to protect the puts. And the same time, if we just hold range or head slightly higher, the value that these puts will lose will definitely compensate whatever expansion this 25% of calls will undergo. So time is 9:26, and yeah, not the greatest start already. Down by close to 4 points and sitting into an IV expansion. Okay, something that can be counterintuitive, but basically into the IV spike, what I've done is I have rolled calls to 15,800, all of them, and rolled puts also to 15,550 by rolling them higher. Reason for rolling them higher is into the IV spike, I'm taking additional credits. So when there is a cool off in the IV, the benefit will be greater than the cool off that I would have experienced in the lower value spread. The reason for that is basically, given current pricing, we are not anticipating too much of a down move. The fact that this 15,700 put, which went in the money at one point by almost 35 points, was still trading at 100 and change, in the between 100 and 110. It gives you the situation that there isn't exactly some kind of big unwinding. And because there isn't enough credit on the calls, I need my calls to be lower. But at the same time, if the market gets bought, then the calls will explode, will not have enough put side credit. So what happens is, the closer you are, the more you'll benefit in a tighter range. But it also means you have larger credit. So in case there is a move, I will have some amount of time to react. So all that being the case, the time is 9:30, and sitting on basically a 250 point spread on a Friday, and we'll see from here what has to be done. Okay, so despite whatever done, we're not really seeing unwinding of 15,700 put. In fact, we are seeing addition, and we are seeing a lot of straddles building up at 15,700. There is slightly more call rating than there is put rating, but yeah, put side not showing too much weakness, so the down move is sort of being used to take on put side trade. So at this point, not really something to be too worried about as far as spiraling out of control is concerned. I will wait for a test of 15,650 and a break from there, and then see if I have to take additional call credit. But until then, just wait. There's no reason to be in a rush. There isn't some kind of, I mean, even now we're trading almost 30 to 33 points in the money for this put, but it's trading at 107, 108. You'll be able to tell when these people start to panic and cover. So that is not happening as of now. So the down move, I would think, is being used to write put options at all levels, really. Now we are testing 15,650 on the downside. I've moved 1/4 of my calls down to 15,750, and in case we actually break and there's no bounce from here also, and we start breaking heading lower, then we'll slowly move all the calls to 15,750. Now this is quite a good put side increase, and in case there is a fall off and we start heading back towards 15,700, which is basically to the day's high, then I will take this 1/4 position and roll it back up here. There's a good chance for such a cycle round figure number to act as a buying trigger for people, which is why I don't want to take too much. I mean, roll down aggressively and neutralize delta at 15,650 when we're making a down. But this is just a slight way to preempt. Anyway, looks like as of now we've taken a slight support, and that is leading to these calls expanding, but overall the position will benefit because the put side fall off will be far more substantial, because 100% of the short puts are just 100 points away. I think given that market is pricing in such low premiums, one has to work with an assumption that volatility is going to be lower simply because of the way market is pricing options. So too aggressive of an adjustment into a directional move should be avoided. The max loss that, I mean, potentially today, let us assume I can gain 10 points from the trade. So the max loss I would be willing to give to the market is probably 5. So at any point, I'm giving 5 points despite whatever I'm doing. That is going to be the end of the trade. Okay, so something to point out here is the 15700 put, which is in the money, has been at 30 lakhs plus and has seen relatively consistent, I mean, not much writing, but it's holding there and slow writing is happening. So people are writing the 15700 put, which is in the money. But at the same time, the thing is, it's not been unbound also. So in case there is some unwinding, that will lead to further downside. So that is something to be very well aware of. That there is put interest. Look, apart from here, is building at 15600. So what might happen is, in case we see a down move, we might see unwinding here and then writing here, or unwinding here also, depending on how bad it is, and writing at 15500. So lately what's been happening every expiry is that people are very comfortable writing call options, not very comfortable writing put options, and this will go on for a while until we consolidate, remain sideways, have a slightly negative bias. There will come a time when insane number of shorts will be built and something will trigger an up move, and that will invariably push the market higher. So that is something to be watchful of. For now, it seems okay as is. I have about 115 points from the downside on my puts. These calls are about 85 points out the money, one fourth the position, and the remainder of the calls are 135 points out the money. So in case we do break that level of 15650 and start heading lower, immediate reaction would be move these calls here. But for now, seems all right. And the fact that people are writing still the 15700 straddle, which is in the money on the put side, shows that there isn't much of a downside expectation. That's at least what I am able to come up with so far. Okay, so far seems to be going in line where we're seeing some kind of a pullback to 15700, at least slightly. Now, the question will be at which point now this one fourth call was moved down to protect the puts, and now these calls are bleeding and they'll continue to bleed because if we reach 15700, they're going to be just 50 points out the money. At which point is it okay to get out of these calls and move them back to 15800? The point at which the premium in this is at least 2 points lower than the premium in this, which means this goes to, let's assume this goes to 40 and this goes to 38. At that point, I'll be like, okay, square this off and move it back higher. So until then, I will not. Until then, like for example, if I move it back now and immediately there's another red candle, fear builds up, this goes up, I just messed myself on both directions. At least if I can let this expand easily all the way till 60 also, no problem. This expands to something like 40, 42 in that range. At that point, I will switch it. And then after that, we'll see any further changes to be done if really there is that much bullish momentum on the upside. To keep you posted, time is 10:08. Okay, see now exactly that condition is being met. We are seeing that this is almost reaching 60. The puts have crashed because suddenly there's buying action pulling us back to 15700. So all these OTM puts, they gave up quite a bit. Calls have gained a little bit, but overall position has benefited. Now I'll not be in a rush. I'll wait for 15700 to get tested. No problem. I will let this expand if necessary to 60-ish. And at that point, if this is at 60, this will be something at 42. And I'll make that switch. So instead of 5640, I'll be getting 6042. So effectively on 9000, I'll be down about 2 points. But that's something I'm willing to do because now since the market is getting bought and a little bit exuberance, everyone's like, okay, 15700 is going to come immediately, but it might not. So no harm in keeping it as is for now. Okay, so we're seeing a slight dip again. Not so much with an IV spike on the put side this time though. We're still 15 points above that is high, but that being the case, if 15650 is tested, the first reaction will be to move these calls down. So if 15650 is tested, they should go back to about 43, 44, 45. This will be trading at something like 47, 48 most likely. I will switch, and from there, if there is any further downside, I will just exit the entire position at that point. But yeah, most likely what I'm working with is that we have a second dip and that dip also gets bought. Okay, so we have now firmly broken today's low and 15650 has been taken up on the downside. Still not any kind of unwinding of the 15700 put, but now I have to pull in the risk management aspect. So I had to move down all of the calls to 15750. Excuse me. Now, if there's a rise from here, the fall off in IV from the put side will still be better than what these calls will gain on an immediate basis. So that's why it's okay to roll down this thing. Right now, the bigger problem is the IV spike is happening on the put side because we have just made three big red candles and broken on the downside the day's low. I will wait for this to potentially lose 2 points, and if that's the case, I'll just, if the position from where it is currently loses 2 points, if that's the case, I'll just take an exit and see if there's a re-entry opportunity. If not, I'll just call it a day there, but depends really on what happens for now. Right now, we are in an IV spike, so it is we'll have to be a little flexible because these calls are refusing to give up value by a lot. Because they're not sure if this dip gets bought very quickly or not. Whereas these puts are gaining quite a bit as they're now less than 100 points out the money. Okay, so more or less some amount of IV expansion as we made the down move, but cooled off once we picked up from there. And more or less what's happening is I feel like a lot of this down move is being used to write put options. It's IT moving heavily down and little bit on the bank nifty, but mainly IT that's getting pushed down, and that is being used to sort of create put option positions. Almost 5 lakh contracts in the past half an hour created at 15500, and yeah, more or less I'm working with a non-cascading down move. Of course, that I could go wrong, and for whatever reason, if I head down to a point where I'm starting to lose, so at that point I decided 50,000 would be my exit on a mark-to-market basis, or that'll basically happen if 15600 is tested on the downside. So since none of that is happening for now, things seem more or less going according to plan. Something that I might do is if, once we start seeing a cooling in IV, is risk off on both sides, like move the puts away by 50 points and the calls also away by 50 points. And something else I want you to see is pricing bias. See, I mean, right now this put is in the money by like 60 points plus, and we're downtrending, we're trending down clearly, but it's trading at 112, and Nifty was at 15,680 also. It was trading at something like 100. So it's not really the way this is pricing shows you that there's not some big downside expectation. Otherwise, just 40 points of time value for the entire month, and this is 15700 is highest open interest. So from the put side, pricing of the put, it tells you that there's really not that much pricing of downside. And yeah, for now we're just sticking to what the market is suggesting, that despite the continuous down move, whatnot, there really isn't that much downside to be had. And since it's not really troubling any of my risk management part, wherein I'm not giving up too much into the down move, because the puts really are not expanding as much as one would think in such a situation. So all right to continue to stay in position for now. Time is 11 o'clock, and Reliance really carrying the Nifty today. I think since the first candle has shown that some kind of buying action situation in Reliance, trending higher. Bank Nifty flat as a plate, and Nifty IT trending lower so far, now holding range. Regardless, the put side IV fall off is much more than whatever increases there on the calls. For now, we'll continue to hold this position. Really need some kind of a push, strong push to 15700 to then take risk off on the calls. Maybe first with half the position and then more. Okay, so IT might have found the bottom from where it is, and there continues to be strength in Reliance and now potentially Bank Nifty participating. The shorts that have built up in the system and the fact that covering hasn't happened as of yet, it might lead to a situation where if we start to see a pullback to 15700, which is just 30 points away, then that will put me in quite a bad situation with the call expanding, as the put will not be able to balance it to a large extent. So what I'm doing now is just taking risk off on the entire position by moving the put down by 50 points and moving the call away by 100 points. So yes, if there is a put side IV expansion again, the calls will not protect me, but considering that I'm sitting on some gain at this point, I think it's good enough situation to just take all the risk off. There are a lot of shorts in the system, and whenever there are shorts in the system and there isn't too much further downside visible, at some point they will start covering those shorts, and that will lead to buying, which can lead to an up move. So I'm anticipating a potential, at least a spike in call prices, um, if we start heading to 15,700, which will be bad for me. So okay, some slippage in the exit, but basically what I've done now is 15,500 on the put side, good 170 points away, and 15,850. So that is where 170 points away. Quite neutralized at 15,675 and taken the risk off on the entire position. Now, in from this risk off position, more or less, I will be trailing a stop loss of about 3 points. Right, this can still give me a good decay of 4 to 5 points if we hold range for the rest of the day. This is an estimation I'm making based on what I think would be normal premium behavior. And if not, I might have a situation where if we once again have a put side IV spike, might move these calls down to 15,800. But beyond that, will not be doing any changes to the point. From here, about 3 points is what I would be willing to take into a down move as a loss. So we'll keep you posted. Time is 11:30, not even halfway done in the day yet. So I would think based on current pricing, the volatility is in line with the current pricing, but for how long, right? So that's the real question. 15700 straddle now trading at like close to 165. How much more can it lose really? So here's one thing that I did. So my initial expectation was that we will have an up move, and that's why I had switched to the 15500 put, then 15850 call, which would have been fine. But into a down move, I'm still dealing with days of higher actual volatility than what has been suggested by pricing. I actually moved my calls down to 15,800 just so that there's enough premium on them, because when this is trading at 22 and this is trading at 29, it's very easy for this to expand into a down move, especially when it becomes evident that now we're making an up move. And eventually, in order to balance the fact that these expanded, I had to further take in put side trade. So regardless, basically position has come closer by 50 points in either direction. The question that I'm sitting with is how much really further can there be a fall off in premiums? I am trailing a stop loss, so my idea is I am going to be taking home 2.5 points, that's for sure. The rest comes down to what is the extent to which there will be a further fall off in premiums, because midway on Friday with at the money straddle at 160 is quite something, definitely. And there is always a threat of short covering because of the kind of shorts in the system. So let's see. At this point, just trailing in stop loss. I don't see myself making any further changes. I think this value of premium is fine on both. And in case there is a move either in the upside or the downside, should be able to get out still with a 2.5 point profit or so. Okay, so more or less views on point. We're pulling back to 15,700, and that's leading to a pretty good fall off on the puts. Calls aren't particularly gaining because people who are sitting on higher levels of calls sold are not exactly feeling threatened to cover. So 800 and above, not really feeling the pressure to cover. And that being the case, for now the position is doing all right. And from here, trailing stop loss will more or less be mark to market of 2 lakhs. So 5 points will be the criteria for exit. I think more than a spike in call IV, there'll just be a fall off in put IV, because it isn't really a trigger to cover shorts extremely hard or anything. It's been evident the entire day, even into the DPO. When we dipped 60 points below, there was really no unwinding of the 15,700 put. Even now you can see 15,700 got slight unwinding. At one point about lost about 4 lakhs or something. That's about it though. A lot of this strength is coming from now Bank Nifty and Reliance as well, looking quite strong. Well, the continued expectation of upside I don't think is too much beyond 15,700, maybe slightly, but not really too much. Also, the 15,700, yeah, straddle 164. We'll keep you posted at this point, just trailing stop loss. Okay, big up move. Really crashed the puts. Calls have expanded, but the puts have lost a lot more value than what the calls have expanded. So what I'm working with now is, and that's mainly because we finally made that push to over 15,700. So a lot of long put stop losses would have hit at once. Massive crash in put price. Calls getting covered to some extent, but not really some kind of panic cover, especially not at 15,800. Now my trailing stop loss is about 2 lakhs 50,000. So that's where I'm trailing from. What I'm working with now is that while these puts will gain a little bit because the stop loss panic that pulled it all the way till 25, that'll go away. And these calls also should give up. So I'm still quite comfortable holding the same position. Um, Sitting in a very good profit now and have to start thinking about locking in. So we'll keep you posted. Time is 1 o'clock. We've still got 2.5 hours of trading time left. I'm not expecting too much upside beyond 15,700. There is no reason to trigger and cover a lot of the shorts yet. And since I've benefited a lot from the fall off in the put side, I can afford to say that another 2 points from here is my trailing stop loss. Okay, now a continued threat of short covering is very real and benefited enough for the day, so no need to get greedy about it. I'll take the exit and initiate a calendar spread. This position might continue to lose value, maybe even another 3-4 points from here. Certainly might, but I'm gonna call it a day. It's a good enough outcome. What is the issue here? Okay. Oh, I see the issue. A massive fall off in put IV. I don't expect it to fall off more and certainly do not want to take additional put side credit after such a large fall in put side IV. Most likely we continue to consolidate from here at 15,700 and close right about there. This position can easily lose another 3, 4, 5 points. But I'm still gonna call it a day because from here the risk reward isn't really great. Now if there is some kind of IV spike again, then either on the call side or the put side, it's just unnecessary headache. Okay, that's about it. What I can do right now, so the intraday situation is done. Some slippage in the exit. Right now, my Bank Nifty future is doing well. The monthly call is doing well, and even the weekly call. The previous week's expired, so it took additional call credit in the weekly. That's also doing well. So I'm not going to make any changes to this. Keep it exactly as it is. Same thing with Nifty. The future is making a slight loss. The monthly call is making a slight profit, and the weekly call we booked profit yesterday on both weekly calls put together. I think something like 17,000 bucks we booked yesterday. This is also doing well. I won't roll this down or anything. I'll leave it as is. I'm going to look at a calendar spread now on Bank Nifty, and yeah, I'll show you once I've taken the trade. Okay, so the plan is I will be creating a Bank Nifty calendar. I'm shorting the 35,200 and 34,500 strangle, and I will be buying the same strangle but in the next expiry, and I will be doing this with 100 lots. This is a highly Vega positive strategy, which means that any increase in IV from here will benefit us immensely. So it's being entered properly. I'll go over the dynamics of this trade. Okay, done. Obviously, entry you will have slippage, especially in the next week's options, mostly because there won't be that much liquidity in them. So there will be entry slippage. But more or less, I will go over this trade, how it looks. Okay, it look funny because also the future trade is here. So we get rid of this, get rid of this. Okay, so the max profit possible is 3.38 lakhs. This is Vega positive. Max loss possible is 8 lakhs. So risk reward of 0.42. Break even on the downside of roughly 34,300. Break even on the upside roughly 35,500. So that's more or less. I'm going by current straddle pricing of 600. So Bank Nifty. Okay, less than 600. We are outranging the straddle. The only thing here is it is Vega positive. So in case there's an increase in IV, we benefit immensely because our long options, our long strangle will essentially not lose as much value versus what our short strangle will lose. And one thing that's very important here, so if you see this position, right, it's taking up a margin of 46 lakhs. So even in, I mean, the max loss is really not going to hurt me. The max loss, first of all, will happen in very odd situations. It requires some drastic mismanagement or a drastic swan kind of event situation taking place, wherein you get to the max loss without being able to fight. And it's a relatively high probability trade. Probability of profit cannot be calculated because it's two different expiries, but it's a relatively high probability of profit trade. And yeah, I'll keep you posted on how this trade goes, how I manage it. In case it's quite aggressive, you see the strikes. So yeah, I'll keep you posted on this trade. I might not be trading on Monday and Tuesday. Depends. I might be traveling. So in that case, if I do make any changes to this trade or to any of the other open trades, I will post about it on Twitter. And if you aren't following me there, you can look up Bandi Shreyas. Thank you so much for watching. Have a great weekend, and I will catch you mostly on Monday. If not, I'll see you on Wednesday. Take care. Bye bye.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram, and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab, so do not forget to check that from time to time.